85, $25 a barrel, so up 50 cents thereabouts on the morning trade. Let's kick off this morning with Amina Bakr, Deputy Bureau Chief and Chief OPEC Correspondent of Energy Intelligence. OPEC seem to be in the news for all the wrong reasons, Amina. I'm not sure they're comfortable when it's all about fighting with Washington, D.C., but that seems to be the narrative they're caught in. Is this a real story or just a bit of noise? Your thoughts?
Good morning, Sean. Good morning, everyone. And I don't think they're in the news for the wrong reason. I mean, they took a decision that kind of showed, according to data so far, that it's the correct decision. It's the cautious decision to take by adding the 400,000 barrels a day. The conflict or the talks between OPEC Plus and Washington are still continuing. Last night we saw statements from the White House saying that there will be no announcement about a possible SPR release. They are going to be continuing dialogue with OPEC Plus. But I think for the OPEC Plus members, it's quite clear, Sean, that they are not ready to put more barrels onto the market because there is no actual physical shortage on the market. So just adding barrels for the sake of cooling off prices and then having to deal with elevated stock levels, which are already going to increase during the first half of 2022, is just, I mean, it goes back, it's counter-effective for OPEC Plus policy. So the measured approach that they are taking, just according to fundamentals, is the correct one to take. Will Washington accept that, or will we see some kind of action being taken by them? It remains to be seen. But for the time being, the dialogue between OPEC Plus and the White House continues.
Just to follow up on that, Amina, putting aside whether there's a call for more barrels or not, OPEC Plus seem to be struggling just to even meet their current obligation, or not obligation, but at least their own declaration of 400,000 barrels a day per month. It seems that in itself is even a struggle for this group. So the idea of more just seems to be, it's not really a choice. They just can't do it.
I disagree, Sean. I think they can do it because the group collectively does have spare capacity, which we estimate for the entire group to be just under 6 million barrels a day. But for the time being, every country has a quota. And you're absolutely correct that some countries can't meet their quota. Countries like Angola, Nigeria, Malaysia. So the question is, why aren't other countries like Saudi Arabia, Kuwait, the UAE compensating for those volumes? And I think that they are just not willing to first of all, revise baselines. It's a tricky situation. They don't want to touch the baseline issue. Taking market share away from other countries is also going to cause conflict within the group. So for the time being, they're saying it's a sovereign matter if a country decides or has issues of not meeting its quota. So they're leaving that aside in order to keep unity within the group.
Let's go to Asia, to Singapore, with Leo Tamires, Chief Executive Officer of NRG Global. Leo, does it feel, sitting in Singapore amongst all the Asian customers of OPEC, that there's plenty of oil around? We just saw Saudi Aramco hit them all with a nice increase in price this week, with the OSPs coming out of Aramco being quite stiff.
Well, most of the refining margins of the Asian refineries are very good at the moment. So in that sense, it doesn't feel like there is a shortage of oil available. I mean, the refining margins started out good on the gasoline and naphtha cracks, and then followed by the low sulfur gas oil. And right now, jet fuel margins are picking up again with the increase in flights, with the vaccine-free travel lanes that are becoming more and more popular now. So the margins are pretty good, and I think Saudi also saw that and said, well, we want to take a bite out of that and get something out of that too. But it still looks very good. That's of course also fueled by the lack of export, or the decline in exports from China.
The decline in products exports from China to the rest of Asia.
Exactly. Because gas oil demand domestic gas oil demand in China is very, very strong. So PetroChina and as already said that for the rest of this year they will run at full capacity instead of the 85% capacity that we've seen in the last couple of months. They will run at full capacity and will have zero exports. So that obviously helps the refining margins elsewhere in Asia as well. So no, it doesn't feel like there is a lack of oil to be refined and to produce the products.
Leo, we've seen reports that China's imports of crude oil in October were significantly down. The trend line has been in that direction for some months now in China. What's your perspective on that trend line, and should we expect it to change and for the increases to start going into the new year? Your outlook for oil imports into China?
Yeah, the October imports were just below 9 million barrels per day, which is the lowest since almost 3 years ago. Which but it's expected, and that is a couple of reasons for that. One is the state refineries that have been running at lower capacity for maintenance, for other reasons, and for reasons that they didn't want to live up to the higher crude prices, and they didn't want to pay the higher crude prices. The private refineries, they saw a delay in their import allocation, the import quotas coming out. So in October they lost a few days at least of imports because the quota were delayed. So there's a couple of reasons why it was low. I don't think it's a start of a new trend. I think it looks like the November, December imports will get back on track, reaching over 10 million barrels per day again. And then, of course, we will have by the end of January, we'll have the Chinese New Year, which also will increase the activity and the refining ahead of that time. So I think in the coming 3 months, at least, we will see healthy imports again.
Amina, there's a nice headline in Forbes, which we're carrying on our daily digest today, which is OPEC tells Biden, if you want more oil, pump it yourself. It is the sort of oxymoron of this sort of scenario where the U.S. administration is curtailing or discouraging development in the U.S. But it has to be said, U.S. oil producers are choosing not to expand their production. But nonetheless, we are facing a growing threat, possibility of an SPR release as some kind of retaliatory measure. What do you think OPEC would do with that? What does it adjust their thinking in any way?
No, for the time being, Sean, I think the possibility of an SPR release is something that a lot of the OPEC Plus producers are factoring in and did factor in when they decided to agree on the 400,000 barrels a day easing of the cuts. Now, an SPR release, whether from the US or if it's done jointly with other consuming states, is most likely going to bring the price down for a short period of time, but longer term, it's drawing down stocks. It's going to bring a bullish message back into the market. So it's not going to be that effective. And for that short period, I mean, after prices go down a bit and then bounce up, and then what is the US going to do? Release more SPR? I mean, it's a kind of finite resource at the end. They can't just keep doing that. So I think they're OPEC Plus states are downplaying the impact of an SPR release. They don't mind if it happens. They'll be watching, of course, monitoring the market. And as I said, it's going to bring stocks down. So technically, it's good for the group.
Amina, from the point of view of the if you want more oil, pump it yourself sort of thing. I mean, it is a Forbes headline. It's not an OPEC quote, obviously. But nonetheless, the expectation around shale oil production, the return or increase in U.S. oil production, OPEC have underestimated that in the past. Your thoughts on this occasion? Does it even feature in their thinking that the US could add 1 million barrels of oil in the coming 12 months and spoil the party?
No, it's not being featured in any of the reports that I'm seeing so far. It's not like in the past, Sean, where we saw that this was a real concern. And there are lots of hypocritical, I would say, comments coming out of the US. On one side, they're saying we should transition faster. And on the other side, they're asking OPEC to increase production. And that's sending mixed messages to investors in the US on what, and if they're going to back the upstream industry in the US. And these are the kind of comments we're getting from a lot of producers, shale producers, that they're not getting the financial backing because investors are not comfortable with policy. They're getting a lot of mixed messages. So that's why they're having to ask OPEC Plus to increase their production, because they can't meet their own, they're just having difficulty increasing their own.
Let's welcome Dr. Charles Elinas, CEO of Cyprus Natural Hydrocarbons Company and a senior fellow of the Global Energy Center, the Atlantic Council. Dr. Charles, welcome. I'd look for an update from your perspective on the European energy crisis, the idea of gas or no gas, more gas coming from Russia into Europe. It does look like Putin is playing with a mouse here and sort of keeping everybody guessing. Your thoughts on that?
Well, the European energy crisis, as you know, has been caused mostly by a couple of factors. One is the lack of liquidity in gas. Basically, the gas storages were depleted during the last winter and summer, and were not being filled fast enough to cope with winter. Putin has been playing a game, but last night it appears that Gazprom started releasing some of the gas, and already prices have shown a downwards trend in the sense that expectation now is that Gazprom will supply gas to Europe, and they said so, and it's causing a downward trend. Obviously, the other factor that is affecting prices in Europe is the emission allowances, buying emission allowances, which are becoming more and more expensive, adding to the cost. These factors have caused the prices to skyrocket. I believe they're coming down now. I was at a conference last week in Amsterdam where the gas situation was discussed. And the expectation now is that by spring, early spring, we should go back to more or less normality.
But in between now and then, of course, you're going to have very, very high prices with gas. Is there any way around that? Is there any potential, do you think, in Europe as we go deeper into the winter, and we're seeing winter come quite strong, or in Europe and now and also in Asia and China, snow falling in Beijing?
No, there isn't. The Russian gas cannot be replaced, I'm afraid. It's Norwegians are pumping at maximum quantities. Algeria is having some problems, but it's still pumping. United States LNG is finding its way to Asia mostly, not to Europe. So I'm afraid at present, at least, Europe is highly dependent on this Russian gas. There are not many ways around it.
Leo, in Asia, we were saying earlier that on the oil side, there may not be a shortage, but surely on the gas front, it's very tight in Asia, and we're seeing a switching away from gas into oil. What's the outlook for that as we move deeper into the winter in Asia?
Again, I think that situation. You know, you notice that there were power cuts in China and some in India. The situation is not changing. It's not getting any better. So even though, as you pointed out, in China at least they are switching to oil, they are not solving the problem. The coal situation has been resolved to some extent. There is more coal production in China. But
there's a lot. Let me get Leo's view on that, Charles. Just Leo, your thoughts on that, the outlook for further switching from gas to oil in Asia as the winter bites.
Yes, not only to oil, but also to coal, especially in China. Even though coal prices have plummeted in China over the last few weeks, the outlook is that they will put a lot of the power plants back on coal to come up with to replace the very expensive gas prices. And we'll see that in other places as well, where they are able to do that. And people will start rationing. I mean, Pakistan just paid the highest ever price, the highest price they ever paid for gas for LNG, over $30. And we see those kind of spot prices in Northeast Asia as well. So yeah, there will be replacement by oil and by coal, especially in China.
Leo, this is the second time this year we've seen these record high LNG prices. We saw them in January in Asia. Now we're seeing them again in November. Is it triggering any sort of bigger thinking, longer term? We can't deal with this every year, every 6 to 8 months. Is it shifting the way Asia thinks about LNG?
No, I don't think so. I think, if anything, it will shift investments in FSRUs or in onshore facilities to import gas. I don't think that there's a shift away from the idea that LNG is good and
is the solution.
Is the solution, at least part of the solutions. But no, we'll see much more investments in infrastructure to be able to handle this.
But the challenge there, of course, is getting access to capital. I mean, the likes of Bangladesh, Pakistan, and others getting those multi-billions of dollars needed. Amina, looking at the last few days of COP26, are we at a point, do you think, to say OPEC are cheering from the sidelines? It's been a bit of a non-burger. Any outcome, any thoughts from an OPEC plus oil producer perspective on COP26?
So Sean, we saw that OPEC Secretary General Mohammed Barkindo is currently at COP, so he's participating, kind of conveying the group's thoughts, etc. OPEC Plus is not against the energy transition. That's not the case at all. And this year we saw a lot of OPEC Plus states, especially from the Gulf. We have the UAE, Saudi Arabia, Bahrain. They all set net zero targets. So I see that as progress. I know that there's a lot of criticism on when they set the targets, by 2050 or by 2060, and how they aim to achieve that. But the fact that they did set them and they have programs to reach that, it's I think it's a big step forward.
Charles, we saw coming out of COP in the last few days a series of sort of declarations, if you like. We had Holland declaring, sort of from a government perspective, an end to funding fossil fuel investment. Germany now announcing today, California signaling they may do the same. Your thoughts on that initiative and what the impact it may have on the markets, the energy markets, that is?
Well, it's becoming quite serious because more and more institutions, banks are shying away from funding fossil fuels, oil and gas. There was some information released by Goldman Sachs only a couple of days ago, showing that the cost of capital for oil companies, for oil, is going up tremendously. So projects now, new projects, must make returns of 20% plus to be able to break into profit. As a result, funding of oil projects is becoming that much more difficult. At the same time, funding for renewables has gone down dramatically. So the number for renewables, instead of 20%, is 3 to 5%. So this year, apparently, most of the funding, energy funding globally, will go into renewables for the first time in comparison to oil and gas.
And looking at the COP outcome, as we say, coming to the end of the towards the last final days, is there anything else you've noted, Charles, coming out of Glasgow that you're paying attention to for its relevance to the energy markets, oil and gas?
Well, it's what you implied earlier on. COP26 doesn't seem to have made an explicit statement to go away from oil and gas, away from fossil fuels. COP26 has not been the success that it was expected to be. On the other hand, though, there are a lot of small decisions have been made to the extent that the International Energy Authority now estimates that global warming will be below 2 degrees centigrade by 2100. They estimate to go down to 1.8. So despite the fact that the headlines have not been glaring, that COP26 made some really important decisions, nevertheless, it has been successful in achieving what it has tried to do, which is to bring back global warming to within the Paris Agreement range. And the impact on oil and gas is not as strong as it has been, mostly as a result of recognition that we have a problem. We have a problem with intermittency. As we go more and more into renewables, intermittency is becoming a serious problem. It hasn't been resolved. There is nothing to, and there is no hydrogen. There is not enough nuclear to cover the time when the sun is not shining, the wind is not blowing, and we have to rely back on oil and gas. As a result of that, there is a recognition that at least until hydrogen comes into play on its own, we have to rely on oil and gas.
Well, it seems, Charles, it's not only relying on oil and gas, it's more notably coal, Leo, looking at China in the midst of COP, instructing its coal refineries to pump to the maximum. Should we question China's sincerity about the commitment to the transition? Your thoughts of these two things coexisting, COP26 and maximum coal production in China?
No, I think that is just a pragmatic short-term decision, and doesn't indicate a policy change away from the energy transition. At the same time, they have announced that they are decreasing or stopping financing of overseas investments, coal investments. So I think that the policy is still the same, but it is pragmatic. They need the electricity, they need the power. They don't have anything else cheap enough available at the moment. So they're using more coal on the short term. But I think it's a short-term decision, not a policy change.
Well, yeah, it's. I suppose only time will tell. But ultimately, Leo, on that, how did China find itself getting into this corner of this crunch? Is there any one simple explanation that suddenly China's facing significant power shortages going into the winter?
No, actually, I haven't found what exactly the core, if there is a core reason, what the core reason for it was. It seems to be a combination of lack of immediate availability of fuel, of infrastructure, or maintenance, or breakdowns. I think it was a combination of things that like Murphy's Law, and then all started to roll over each other.
And the surge in global demand from everything from laptops to Barbie dolls. Let's go to this.
And factory production is very, very strong in China. Exports are very strong, so all the factories are running at full power.
We have the China factory inflation hitting a 26-year high, as reported today out of Beijing. All the reason why one might want to agree with this statement that Brent crude oil price will rise to $90 a barrel by the end of November, not the end of the week, but the end of November. Do you agree with that statement or disagree? After OPEC's decision last week, and the reduction in inventories, we didn't even mention that in the US yesterday, API reporting a decline in inventories. Is there anything to stop Brent crude oil reaching for the stars? Agree or disagree with this statement? I will take it around for the final comments. Amina, your thoughts on that? I know OPEC always says they don't have an oil price target. They're looking to balance the market and all such things, but they can't be unhappy at 85 heading to $90 a barrel.
Yeah, you're absolutely right, Sean. A lot of these economies are looking to recover from what happened in 2020. So I think they're very happy with where prices are and would like to see prices where they are for the time being. I think they're just going to keep a steady hand, keep easing those cuts by the planned amount.
Is there anything, Amina, in the thinking where, as we mentioned in our earlier comments, where the few countries, i.e. Saudi, maybe the Emirates, who have the capacity to add barrels, that they actually would make up for the shortfall, at least deliver that 400,000 per day per month that they committed to?
For now, no, Sean. They're not even considering that. They're not looking at that. And I said it's going to create a lot of tension in the group when suddenly they say, okay, the UAE and Saudi Arabia are going to take over some of Nigeria's barrels or Angola's barrels. So that's not even an option. But I agree with you on the fact that this issue needs to be addressed, because those numbers aren't actually hitting the market. And what makes me think that prices are going to rise, I mean, yesterday we saw a move from Oman to cap gasoline prices, so their customers won't feel the backlash when oil prices increase. So that makes me think they're getting ready for prices to go up further.
Charles, we have the sort of major political leaders in the West, at least. I mean, Macron noticeably yesterday, and Japan has been on it, the US. It's not just Joe Biden screaming a little bit about higher oil prices. All said and done, however, is it a genuine posture? Is it something that's going to squeeze the OECD countries' oil prices at these levels, given that inflation is coming from so many sources, most notably the central banks continuing such an easing and quantitative easing strategy?
Well, if oil stays in the low 80s, I'm not so sure that it will be the main factor. As you said, there are many other factors affecting inflation, but we have to look also at the longer term. I am concerned that the messages coming from everywhere, including COP26, are affecting long-term planning. There is no long-term planning anywhere. Nobody knows, nobody can be sure that if you fund an oil project now and it needs 20 years life, that it will be there for 20 years. As a result, funding on oil projects is being affected by this uncertainty, to the extent that even ExxonMobil yesterday said they are now reconsidering some of their long-term projects. That is what is going to have a huge impact on future oil prices and future gas prices and ups and downs. And this problem we're having at the moment of high prices for a period, low prices then, and afterwards back again to high prices may continue for some time, for a long time, as a result of this lack of longer term investment.
Well, I think that's probably the biggest legacy of COP26, not only coming out of it, but even before going into it, the discouragement of investment into fossil fuel projects will keep a squeeze upwards on oil price as demand recovers. Leo, final word with you. Let's get the survey result on this question. What the room's view here is, there is a certain view that the bulls are in the room, oil prices are continuing to squeeze up. Anything from your perspective, Leo, to stop that upward motion in oil prices after we've had the recent correction? We went from 85 down to 80 on Brent and now back up again.
I agreed as well that short term we'll see this because the market has momentum and it will continue to go. I don't see it going much further than that. I think other origins will start pumping in. Maybe we'll finally get the shale going again in the US. Nigeria seems to have solved their problems and will start increasing their output again. Angola as well. So all those other countries, and Iran keeps on exporting oil as well, crude as well. So I think there will be sufficient oil, sufficient crude to not to flood the markets, but to supply the markets.
To certainly maybe meet. I mean, we had another story on our digest today we haven't mentioned, but just to wrap up on it, we have Russell Hardy, the CEO of Vitz Oil, the world's largest independent oil trader, saying we're already at pre-COVID levels of 100 million barrels a day, not 96, 97, we're already back there. And I suppose if I was OPEC plus, I'd be looking at India and say, who are one of obviously their big customers, and also a country that they have to have sensitivity around. Fuel demand rose in October to a 7-month peak. So nobody seems to be discouraged from buying fuel oil products in India at these prices. And I think from an OPEC plus signal, they'll be going, well, if India isn't screaming, we're going to keep on with this strategy. Let's wrap up there just to highlight that we have an interview today with one of our regular commentators, Rustin Edwards, one of the best commentators on the shipping markets. His reflection on the year past and outlook for the year ahead. We'll be doing a series of these interviews over the coming weeks as we come sort of to the end of the year, shipping, trading, storage, etc., getting views, sort of an overarching view, and shipping was the first to kick off. So if you have 20 minutes, I'd recommend listening to that. All the best, Amina Bakker. Thank you as always. We have ADIPEC next week. I'm sure we'll see you there. That might be another reason for oil prices to go higher, because you're going to have ministers commenting every 5 minutes for 5 days about why they're not going to increase oil supply. And I'm sure that's going to be another reason to keep that popping. Maybe 90 will happen during ADIPEC week. Leo Tamiris, as always, thank you so much from Singapore. Dr. Charles from Cyprus, really appreciate you joining us. Have a great week, and we'll catch up in the coming days. All the best.
Thank you, Sean.